Okay, let's talk seriously about position sizing. And I know that Matt already covered position sizing in depth in the long form video. It is so important, it's worth talking about every time you trade. So, the position sizing rule is one of the things that will keep you safest as a trader. It'll help you consistently keep your discipline as a trader so you don't overexpose yourself to risk and you don't wind up making dumb, expensive mistakes. So we want to avoid that. So what we're going to do and what you're going to commit yourself to right now, I want you to repeat after me. Say, Noah, I promise I will position size consistently for my account size. And you say that. Noah, I promise I will position size consistently for my account size. Now, there's a rule for the step system. Okay. And this rule is that you're not going to use more than, say, 5 to 10% of your capital to buy the stock. And you're not going to risk more than 1% of your total portfolio. Now, that number is somewhat debatable. Like I have seen some traders use 2% and 1.5% or 0.5%, using different variables there. But the key is consistency and that you're not exceeding pain thresholds and personal risk tolerances. So again, asset allocation, this is the magic word, how you use your capital, allocation. And again, 1% of total portfolio. So let's keep that in mind. Now, I'm going to jump over into the Thinkorswim platform, and we're going to use Disney as an example for this. And so in a previous video, we talked about position sizing to the stop loss. Well, here we're going to talk about the same idea, but I'm just going to show you how to organically do the math real quick. It's not hard. So we were talking about putting in an entry up above 143.26 or so, and putting a stop loss down below the support pivot. And I'm just going to use this little trend drawing tool. So just a regular trend line from the drawing tools down here, just this regular trend line. It's got a measuring stick on it. So you can go and say, okay, well, I'll be buying above 143.28. That's fine. And I'm going to click here and I'm going to pull this down and I'm just going to measure the distance to my stop loss. I want to get down below this support pivot right here. So I'm going to pull that stop loss down and just use the crosshairs to ballpark it and get the stop down below 137.74. I think I'll go ahead and roll it down to like 137.60. So that gives us a number. You can see up there, it says 5.61. That's points. That's $5.61. So $5.61. Now, I'm going to grab my calculator here. And if we had a $50,000 trading account, 1% is $500. That's easy math, right? If you had a $10,000 trading account, 1% is $100. If you have a $100,000 trading account, 1% is $1,000. So if we were to take that I believe it was 526, or excuse me, let me double check that measurement one more time. What did we say? We said measurement from 143.28 down to 137.60. That was 568. 568. There you go. 568. So $500 risk divided by 568 or 5.68 points, and it gives me the little decimal point, 0.88. So I can do 88 shares. Okay, and you can probably figure out a couple different ways to do the math. It's pretty basic arithmetic there. But 88 shares would be the most I should buy if that was the stop loss method I was going to use if I had a $50,000 account with a 1% risk tolerance. So you have a good idea of how to go about determining that position size. You measure the distance between your entry price and your stop loss. And then you take the number of points or dollars and cents between the entry and the stop. And then you basically take your risk tolerance, divide the distance in points into your risk tolerance, and that'll tell you how many shares you need. Pretty simple concept. You got the drawing tool inside of the scouting reports on the charts. You can use that. And there's other tools and techniques you can use. But always position size that stop loss to your risk tolerance on your account and follow that portfolio risk management rule religiously.